She invested £180 a month, the same amount as one streaming subscription plus one takeaway. She started at 24. She never stopped. She never picked stocks. She never watched the market. By the time she was 64, that £180 a month had become £7 million. The question is not how she did it. The question is why almost nobody does. This episode answers that question. Not with motivation, with maths. The window exists. It is measurable. It closes. And most people are not told when it opens. A financial advisor, a stockbroker, and a compound interest calculator walk into a bar. The calculator orders for everyone. 20 years later, it owned the bar. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions. Money Unlocked is a series about one thing: the financial decisions most people are never told about. This episode is the beginning. We start with why the window exists, what closes it, and what happens when you miss it. Nadia has spent a decade tracking how institutional advisors explain, and don't explain, compound growth to retail investors. The finding that stopped her was not a market crash. It was a percentage. If you find this useful, subscribe. New episodes every week. The ONS Wealth and Assets Survey, published 2000 to 2010. Source: Office for National Statistics, Wealth and Assets Survey 2010. Median pension wealth for UK adults aged 35 to 44, £58,000. For those aged 55 to 64. Same country, similar incomes. The gap is not explained by salary, it is not explained by luck. It is explained by time. Compound interest is not complicated. The money grows, then the growth grows, then the growth on the growth grows. The longer that process runs, the more the early years dwarf everything that comes after. The mechanism is not what most people are never told. What most people are never told is how much the first 10 years matter compared to every decade that follows. The MSCI World Index, 55 years of data. Source: MSCI World Net Return Index, 2024. £1 invested at 25 at the MSCI World Historical Real Return of 7% becomes approximately £21 by 65. The same £1 invested at 35 becomes £10. Same investor, same fund. Same behavior, a 10-year delay cuts the outcome by more than half. So the years I am in my late 20s, those are worth more than the years I will be in my 50s? Even if I have less money now? The years when you have the least money matter the most, because those are the years the clock is running. 100 at 25 does more work than £1,000 at 45. That is the part most people are not told. Here is what this looks like in numbers. £50 a month, or whatever that is in your currency. Invested from age 25 into a low-cost global index fund at the MSCI World Historical Real Return of 7%. Source: MSCI World Net Return Index, 2024. By age 65, approximately $262,000. The same £50 a month starting at £35, approximately $130,000, starting at 45, approximately $60,000. Same contribution, same fund, same rate. Different start date. Vanguard published research in 2023 on catch-up contributions. Source: Vanguard, 2023. To compensate for 5 missing years starting at 25, an investor must contribute 43%. Source: Vanguard, 2030, more per month for the remaining 35 years. To compensate for 10 missing years, 89%. Same source. More per month. The math does not allow for easy catch-up. The early years are not replaceable with a larger contribution later. Hold on. £50 a month, that is less than most people spend on a gym membership. And 40 years of that is over £250,000 at the MSCI World Historical Real Return of 7%, using ONS Index Fund Return data. Source: MSCI World Net Return Index 2024. Yes, and that assumes no employer match, no ISA wrapper, no tax relief. Most people have access to at least one of those. The actual number is typically higher. In 30 years at an institutional investment desk, the most common thing I heard from clients when they first saw the compound growth curve: "I wish someone had shown me this at 25. I always thought you needed a big lump sum first, like a significant amount, before it was worth starting." The compound curve does not care about the size of the starting amount. It cares about time. £50 a month started today builds a larger foundation than £500 a month started 10 years from now. The amount of the contribution determines the destination. The start date determines whether compound interest has time to work on it. The action this episode produces is 4 steps, not concepts, actions. Step 1. Open a stocks and shares ISA, or a TFSA, or a Roth IRA, or a low-cost brokerage account. Whatever is available in your country. Links in the description for UK, Australia, and Canada. Step 2. Find one global index fund, MSCI World, S&P 500, or a total market fund. Step 3. Set up a monthly direct debit or automatic transfer. Any amount, £20, 50, whatever is genuinely affordable. Step 4. Do not look at it daily. Do not look at it at all. Check it once a year. Rebalance if it drifts more than 10% from your target. The people who end up with the most are not the ones who watch the market daily. They are the ones who forgot they had invested and kept going. Do it once, make it automatic, then leave it to run. Right, quick one, 30 seconds. Stay with us because this is the part most people miss. The Federal Reserve published research in 2022, analyzing 70 years of S&P 500 data. Source: Federal Reserve, FES Working Paper, 2022. Investors who waited for a 10% market pullback before investing, on average, waited 789 days. In that time, the market rose 7.3%. Source: Federal Reserve, Fed's Working Paper, 2022. They waited for a discount, they paid a premium. Right, back into it. Lightning round. 5 facts, 90 seconds. The average age UK investors first put money into the stock market: 38. Source: Office for National Statistics, Wealth and Assets Survey 2022. The average UK investor starts 13 years after compound interest delivers its highest return. A 10-year delay in starting cuts the final portfolio value by approximately 53%. Source: MSCI World Net Return Index, 1969 to 2024. Not a small setback. More than half the outcome gone. Fewer than 12% of active fund managers beat the index over a 15-year period. Source: SPIVA Europe Scorecard, S&P Global, 2023. The index owned passively outperforms 88%. Same source of actively managed funds over 15 years. Waiting for a 10% market pullback before investing costs 2.3% per year in missed returns on average. Source: Federal Reserve, FES Working Paper, 2022. Waiting for the right moment costs more than the wrong timing it was trying to avoid. £50 a month from age 25 at 7% real return. Approximately $162,000 at 65. Source: MSCI World Net Return Index, 2024. From 35, approximately $130,000. The difference, $130,000. The cause, 10 years. The 1% detail for this episode. The MSCI World Index has produced a positive return in 78%. Source: MSCI World Net Return Index, 196.9 to 2002. But here is what that statistic does not tell you. Of the 22%, same source, of years that were negative, the average recovery time back to the previous high was 13 months. Not years, months. The index has not produced a negative return over any 20-year rolling period in its entire 55-year history. Source: MSCI World Net Return Index, 1969 to 2024. What they never tell you. The FCA conducted a review in 2019. Source: FCA Financial Lives Survey 2022. It found that fewer than 12% of retail investors had received a clear explanation of compound growth from their financial provider. The information exists, it is not reaching the people who need it most. That is what this series is for. This episode established the window and why it closes. Episode 2 asks, once you have decided to start, what do you do with the money? 3 people, 3 approaches, 1 clear pattern in the data. The panel question for this episode: at what point does starting feel too late? Maya says there is a number. Nadia says the data does not support the feeling. Marcus has seen both outcomes firsthand. Their disagreement is in the comments. Add yours. The window does not close all at once. It closes a little bit every single day. Today is still earlier than tomorrow. Next episode: 3 people with similar incomes. 3 completely different outcomes. One had a plan they had never thought of as a plan. We break it down step by step using their actual numbers. Subscribe, new episodes every week. Kai set up his first index fund direct debit after filming this episode. It took 4 minutes. He spent longer choosing what to have for lunch. He then spent 40 minutes explaining compound interest to his sister. She immediately asked why nobody had told her this before. The answer is in the description. Next episode is up there. Subscribe is over there. Both are better than whatever you were about to do instead. I know this because I have watched the next episode. I understand all of it, I have done approximately none of it yet. That is what the subscribe button is for.